Good news on the Trump economy. The World Economic Forum ranking the United States as the most competitive economy in the world for the first time in a decade. Joining us right now to talk more about the backdrop for investing is the president of MacroMavens. She is Stephanie Pomboy. Always a pleasure to see you, Stephanie. Thanks so much for joining us.
Thank you very much for having me.
Your read on the backdrop right now in terms of the economy, because we continue to talk about how well everything is doing,
right,
but you always have some negative out there that you say, wait, don't forget this. So give us the holes in the story.
I'm trying to identify the unseen risks out there. So I'm, by nature, antagonistic with whatever the view is at that moment. And right now, I think, the president is right to be concerned about what the Fed is doing, because he's got, the deregulation taking effect and the effect of the tax cuts, which have all been incredibly positive. And they've kind of masked what's been happening with monetary policy in terms of the drag we're seeing already from higher interest rates. I mean, the consumer actually has experienced higher rates since the Fed started raising at the end of 2015. Corporate sector has been in another world, but consumers have experienced steady increases in rates, and we've seen, an uptick in delinquencies, not surprisingly associated with that. But more urgently, we're now seeing real declines or deceleration in housing and autos, which are the twin pillars of economic growth. So as those two sectors start to lose momentum, and they actually peaked a year ago, that's going to be an issue for the economy moving forward. The bigger issue to me, though, is what's going to happen on the corporate front now that rates are starting to move up in the corporate sphere as well, which we hadn't seen to date, because there's been a massive levering up of corporate balance sheets. As we all know, they added $3 trillion in debt post-crisis. And contrary to popular wisdom, they didn't lock in long-term debt at record low rates. They actually have financed a fair amount of that short term. So we have a lot of debt that rolls over the next few years. Next year, $780 billion of corporate debt rolls. So that's going to be a major issue as rates are moving higher, because balance sheets are obviously very levered and their cash positions are not nearly as good as, again, popularly perceived, because all the cash is on the balance sheets of the top 25 companies.
So what you're saying is the economy is not as strong as it looks. The Federal Reserve maybe could overreach with too many hikes.
I think that they could push too far. I think the president is right to be worried about what the Fed is doing. History suggests that the two things that they excel at are decreasing the purchasing power of the dollar and inflating bubbles and then inadvertently bursting them. That's been the two things that they do perfectly. So I don't think it's unwise to bet that they might make that same mistake again.
So we don't want to defend the history of the Fed here. Obviously, they've got a lot of disasters on the resume in terms of inflating credit bubbles or deflating the economy. But in this case, you've got inflation at about the same level as the Fed funds rate. I mean, shouldn't the Fed funds rate be above inflation, as it often is, normally is?
So the problem with putting this in historic context is that the consequence of these serial Federal Reserve reflations, or, these decreases in rates where they overstay accommodation and then they belatedly pull things in, is that it has the effect of encouraging people to lever up. So what we've got now is record leverage in the economy. Therefore, it takes a smaller and smaller increase in rates to cause problems. And you've seen this. If you look at a chart of long-term bond yields, obviously we peaked back in the early 80s, and we've had financial crises at lower and lower levels of rates for the last 30 years. So there's no reason to believe that we can suddenly go to 4% on the 10-year without unleashing all kinds of damage. 330 was sufficient to burst the energy bubble back in 2014. So our vulnerability to increases in rates is so much higher today. And again, with the corporate sector having all this debt that's coming due in the next year, they've got, again, $780 next year, and they have $2 trillion in debt that comes due in the 2 years after that. So there's going to be a lot of immediate impact from
So speaking of debt, how much does it worry you, the deficit in the short term? It's at $779 billion, a 17% increase in the past year. Is that more of a longer-term problem that you think politicians need to worry about, or do you think we'll see a short-term reaction in the markets?
Well, I guess I don't worry as much about the deficit because my conclusion is that the Fed's going to go too far, and then they're going to have to rush in with the fire hoses, and that will entail massive purchases of government paper again, as it did the first time. It'll just be much bigger than the QE we saw the first time.
You're saying that you think that that monetary stimulus from the Federal Reserve will be bigger than the $4.5 trillion in bond buying?
It's going to make 2008 look like a warm-up. I think what they've done silently, and James and I have talked about this a little bit, in this period post-crisis, they have silently bankrupted the entire pension system of the U.S. Actually, the Federal Reserve came out last week, and no one really noticed this, but when they reported their flow of funds, which is their quarterly, financial assessment of the entire economy, they revised the pension underfunded status by $2 trillion. I thought it was a mistake when I looked at it. I was like, $2 trillion. It went from $4 trillion deficit underfunding to $6 trillion on their revision.
And it's because they kept rates at 0%.
Exactly.
But you know what, Stephanie? Americans do know that. People who are retired, they do know what the Federal Reserve's been up to post-crisis because they have been forced, if they want income, they've had to take greater risk to get income. That they did the right thing. They saved. They were smart with their money, and they got stuck.
Nothing.
Yeah.
Nothing.
They punished responsible behavior, but that's going to be an issue because if and when the market's correct, we're at $6 trillion now. Obviously, then if stocks go down and pensions have 50% of their holdings in stocks, there's going to be a huge hit. So you could see that pension number go from 6 to 10 overnight. And how are they going to fix that problem? I mean, obviously, we're going to have massive money printing. I'm jumping years ahead.